Everything you need to know about ETFs and the best ETFs to invest in 2022. Choosing the best ETFs to invest in could make all the difference between becoming a billionaire and gradually losing your money over time. You can be dealing in the wrong ETFs given that there are currently over 8,000 ETFs listed on the stock market. So, in this video, I'll share with you the best ETFs to invest in today. Learn about the things you must consider so that you only invest in the best ETFs with the highest potential returns. Hi there! Welcome to MakeWire. In this channel, I'll show you the best tips and tricks in the financial spaces, business, and entrepreneurship. MakeWire is created to help as many people as possible make money online from the comfort of their homes. Just sit back, relax, and learn how to make money work for you. Be sure to subscribe to my channel and hit the notification bell so you're always updated on my latest videos. Let's get into it. First, let's talk about why you should invest in ETFs. Essentially, ETFs combine the advantages of index funds with stocks. Now, the benefit of stocks is that you can buy and sell them anytime, as long as the market is open. Hence, they are liquid investments that you might immediately sell if necessary. But the thing is, stocks aren't very diversified. Suppose your portfolio consisted solely of the one stock you own. The future of your investment is now dependent upon the performance of the stock of that company. Imagine that in September 2021, when the Meta stock was trading at roughly $375, you put all of your money, say $100,000, into Meta stock. Your $100,000 portfolio would now only be worth roughly $50,000 because the Meta stock has declined to 52% since last year. This is when index funds really come in handy. Index funds are a collection of hundreds and even thousands of different equities bound into a single stock. They are varied investments, so you're not just investing all your money into one stock. So, now you know why it's so much better to invest in ETFs rather than index fund and stock. Now, let's head on to the next thing you need to know about ETFs. ETFs combine the greatest qualities of equities and index funds into a single handy package. ETFs are also exchanged on the stock market. Likewise, you are free to purchase and trade them as long as the stock market is open. ETFs are diverse portfolio investments which can hold hundreds or even thousands of assets, just like index funds. Imagine all of the individual stocks are combined into a single ETF. You can really maximize your investment here. When choosing which ETFs to invest in, there are a few factors you should always keep in mind. The ETF issuer, who is actually issuing the ETF, is the first thing you need to consider. Is it Charles Schwab, Vanguard, or Invesco? For investors like you and me, there are more than 200 different ETF providers. But not every ETF provider is the same. Choosing the wrong company can significantly affect how well your investment performs. Make sure you're investing in the ETF provider that has the stability and technology to control expenses and expertise to manage risk effectively. Okay, moving on to the next thing you need to think about. One part of an ETF that should not be ignored is the expense ratio. The expense ratio calculates the annual cost of owning that ETF. This money is used to cover expenses, including fund management fees, marketing expenses, and any other related charges. The expense ratio is expressed as a percentage of your fund investment. For instance, if you put $1,000 in an ETF with a 0.04% expense ratio, you will pay $4 in annual fees on that $1,000. This payment you make does not operate as an automatic withdrawal from your bank account like a subscription does. The costs are instead deducted directly from the investment. Due to this, expense ratios within an ETF are vital over the course of your investment's lifespan. A high expense ratio might eventually lose you hundreds of thousands of dollars. I hope you guys are still hanging on there, because there's a few more things I'm going to share with you, so stay until the end. Now, on to the next thing you need to consider. The dividend yield of the ETF is the next factor you should consider. Dividends can either be the best or worst thing that can ever happen to you. Dividends are fantastic if you're put in a tax advantage account, like Roth IRA. Your dividends within these accounts, particularly the Roth IRA, are shielded from Uncle Sam's taxes. Nevertheless, your dividends are taxed as they are paid to you if you invest in a regular brokerage account without tax advantages. Your tax will vary based on whether these dividends are eligible for tax or not. Qualified dividends are treated as a long-term income. Therefore, your dividend tax rate will either be 0% or between 15% and 20%. Non-qualified dividends are immediately taxed as regular income in the applicable tax bracket. The amount of taxes you must pay on such dividends will therefore vary depending on your tax bracket. Nevertheless, over time, especially if the ETF delivers a greater yield, all these taxes on your dividends will reduce your investment returns. This might not be a significant concern for some investors, specifically if you're trading for income. Dividends, however, are actually bad if you're investing long-term, say for retirement, and you're not investing in a tax-advantaged account. Okay, moving on to our next point. The assets under management are also a crucial aspect to when investing in ETFs. An ETF would have $1 million in assets if 100 people invested $1 million into it. Now, generally speaking, the more assets an ETF manages, the better. It's a sign that many individuals are making investments in that ETF, indicating that it's probably an excellent investment. This ETF will also have a lot more liquidity, which will make it simpler to trade on the market. Make sure to watch this video until the end because I'm going to share with you the best ETFs to invest in. All these ETFs have billions of dollars in assets under management. Next thing that I'm going to talk about is the turnover rate. The turnover rate of ETFs is another factor to think about. Only actively managed funds, like the RQTF, are covered by this. The frequency of stock trading is determined by a fund's turnover rate. Higher turnover rates for ETFs typically result in higher capital gains, taxes, fees, commissions, and other charges, which are deducted from the fund's assets. This has an immediate impact on you as the investor. Some actively managed mutual funds and ETFs employ fund managers who actively trade stocks in an effort to boost their own commissions. That's a real bad thing you should avoid. If you have a manager or plan to have one, make sure they're 100% honest and trustworthy. A turnover rate of greater than 20 to 30% is often regarded as highly skeptical. You shouldn't buy into that ETF. On the fund's detail page, you can find the turnover rate. For instance, to find out the turnover rate for this Vanguard fund, I would keep scrolling to the portfolio composition and find out that it is a typical 25.1%. This rate is normal, so it's all good. Now, we're down to the last thing you need to consider. Later, I'll finally tell you the best ETFs to invest in 2022. The underlying index of ETFs is the last aspect to take into account. The majority of people solely consider the expense ratio, assets under management, and funds issuer when selecting their ETFs. All of those things are, of course, crucial. However, there is one factor that the majority of people never consider. I believe this is the single most crucial factor you should take into consideration when deciding which ETFs to invest in. That is, my dear friends, the underlying index and the weight of the stocks that make up that index. Let's use this amazing free tool called Fund Focus. This one is on the ETF Research Center website or etfrc.com. If you enter VOO here and examine this ETF more closely, you'll notice that it primarily invests in large cap equities. You wouldn't have any exposure to small and mid cap stocks if you invested exclusively in VOO. Additionally, you can be losing out on some fairly large gains. If you hadn't known to look at the ETF's underlying index, you would have never known that small and mid-sized stocks have significantly higher potential growth than large-cap equities. Next, let's look at the weighting of the stocks that make up that index. Of course, you can still retain VOO in your portfolio and increase your exposure to mid and small cap stocks. Simply look for another ETF that also invests in mid and small cap companies, such as the Vanguard Mid Cap and Vanguard Small Cap ETFs. And that's everything you need to know about investing on ETFs. As I promised earlier, I'm going to share with you the best ETFs to invest in 2022. I'm not going to keep you for too long because here they are. For the best dividend ETFs, check out Schwab US Dividend Equity ETF or SCHD, Vanguard Dividend Appreciation ETF or VIG, High Dividend Yield ETF or VYM, and Invesco S&P 500 High Dividend Low Volatility ETF or SPHD. Now, if you're looking for the best growth ETFs, you might want to consider Vanguard Growth ETF or VUG, Invesco Triple Q ETF or QQQM, Vanguard S&P 500 Growth ETF or VOOG, and finally, Vanguard Information Technology ETF or VGT. There are other ETFs you can also invest in. These are Vanguard Real Estate ETF or VNQ if you want to invest in real estate, Vanguard Total Bond Market ETF or BND if you want to try bonds, and finally, Vanguard Total International Stock ETF or VXUS if you want to try investing in markets outside the United States. So, there you have it. I hope you learned a lot from this video. Be sure to consider all these factors when choosing which ETFs you will invest in. Do your own extensive research as well. What other investment topics do you want to learn next? Comment down below. Check out my other videos if you want to learn more about investing and making money online. Thanks for watching this video. If you like this video, share it with your family and friends so they can also make money online. See you later!